So today I'd like to talk to you about setting up your business, and in particular the format that you are going to choose to use to run your business. So the three things I'm going to talk about are setting up as a sole trader, as a partnership, or as a limited company. So by far the most easy way of setting up your business is as a sole trader. So you simply go onto the HMRC website and you register for self-assessment and tell HMRC that you've started trading, and away you go, and you can sell products or you can sell your services, and obviously you need to keep the records so that you can fill in your self-assessment return at the end of the year. You are your business, which means that you are assessed a tax on the profits of your business, and it doesn't really make a difference whether you put money in or take money out of the business. What you are taxed on is the entire profit that you have made during any given year. So a partnership's kind of the next step up. This is where it's almost similar to having two or more sole traders coming together and operating together as a partnership. If you are setting up as a partnership, strongly recommend getting a partnership agreement put in place, just so that you know how to go about resolving any disputes that might arise. It's similar to the sole trade, so again you simply register for self-assessment. The two or more partners need to register individually, as well as registering the partnership as well. There is an additional tax return, so what you do is you do your partnership tax return, and that helps to allocate the profits for the year to the individual partners, who then populate their own self-assessment returns from there. The third option is setting up as a limited company. This is fairly straightforward to do on the Companies House website, but you really need to know that that's the best option for you first, because with a company comes a lot of extra admin. You need to think of your company as a completely separate legal entity, and the company itself is taxed on the profits for the year. In order to extract that hard-earned income from the company, as a director you would need to take a salary, which involves setting up a payroll. As a shareholder you can take dividends, but again there are requirements before you can take a dividend, and I have blog posts that cover taking a dividend and how you go about doing that. So as a director you pay income tax on the withdrawals. As a shareholder also you would pay income tax on your dividends. So as I said, there is extra admin that is involved when you're running a company. HMRC require you to send a full set of accounts to the latest accountancy standards, along with your tax return for the year. And in addition to that, you also need to send a smaller set of accounts to Companies House, and you need to do an annual confirmation once a year. There are advantages to setting up as a company. On a personal level, it means that you can control what you are taking out of a company from year to year, which means that you are in control of how much you are taxed on, which does bring some advantages. And the other advantage is the limited liability status. So if there is a problem with the company, the amount that you're going to lose is limited to the amount that you've actually put into the company by yourself. Well, that's all I've got to talk about just now. There are other options available, but these are the main three that you might choose to operate in. Thank you for listening.